because it was the Fed that we're trying to interpret, I want to go to you because of all your fixed income expertise. Saying we're staying at zero for years was probably good. I don't know about trying to get up to 2% or above. It's good. But what you said might have been disappointing was we didn't get more clarity on how the balance sheet was going to roll off or when that was going to happen. And that disappointed the stock market. Are you sure? Or was it just, the market's been up a lot?
No, I would suggest if there was any disappointment, I'd start first with what they did. At Jackson Hole, they set up a new long-term framework, average inflation targeting, and that they won't tighten because unemployment's too low. That's not today's problem. Yesterday, they put in the monthly statement or the meeting statement that they won't tighten until inflation hits 2 and goes higher and maximum employment is realized. That puts the two statements together. If there was any disappointment, they didn't do anything with the tools to help realize that outcome. They didn't say we're going to accelerate bond buying. I think I'd call it a modest disappointment. Not sure that the equity market reacted to it yesterday, but there's probably sort of whispers that, boy, the Fed has good objectives. How will they get there?
So, Ryan, you heard that, and you're going to come to you for the equity side of things. Was there anything that disappointed you yesterday? What's not to like about zero till 2024 if you can buy yield stocks with 3%? What's not to like?
Yeah, I'm going to say, I like that as an equity investor, as managing a bond portfolio. I feel your pain. I think it's got to be really hard to find yield right now in a very yield scarce world. And, my clients, maybe like 60% are baby boomers. They need income. And if you start looking at blue chip companies that are trading at a nice discount to our high flying tech companies right now, paying 3-4% dividends, it's a great world to be invested as an equity investor, especially because valuations right now are so much cheaper on your big blue chip companies that are your traditional boring cyclicals, things that have to do with reopening of the economy versus the casino that's become the tech market right now.
What do you think of Snowflake, Ryan?
Outrageous. 100% one day. It sounds like a lot of college students in their dorms that are on Zoom for their college classes that need something to do. So I have to think it's just like pure speculation at this point, Joe.
People that justify it say that these amazing companies that are at the forefront of things like this, that they grow into their valuation. And some of the other ones that were seen the same way years ago, we don't need to mention any names, but look at what has happened to the valuation. It's no longer below, it's no longer 50 or 60 billion. It's some of them are a multiple of that now and grew into it. You don't think that this is one of those. You have to buy them now or you're never going to get them.
100 years of profits, kind of truncated right down to the stock price. That can't end badly at all. I can't imagine that ending badly here, Joe.
You saw how revenue's growing, though, right? Then short it. Are you going to short it? You can make your clients, 100% return in the next couple of months. Are you ready to step up and do that, or are you just like talking about it?
Well, after looking at Tesla and seeing where Tesla is right now, I'm just not that bold. A serious short squeeze is always around the corner. But at the end of the day, look, and it's going to end bad at some point. This looks very, very analogous to 99-2000. And you're starting to see the street start to justify these insane valuations at this point. That's got to be a very bad sign from where I'm standing. But I'm not confident enough to short the market here, Joe. I wish I was that good.
So let's say that everything is up, out over its skis, not just Snowflake. That's just a manifestation. Let's say that things are overvalued in equities. Would that be good for fixed income? Or they're not decoupled, are they? I don't know. Where would money go, and what do you do to minimize if you want to, spread things around and not be exposed to all that equity risk? What would you buy?
Sure. It's a good question. To be frank, though, when you have the 10-year Treasury at about 67 basis points, I think Ryan mentioned that discounting future profits. Well, the discount rate is historically low, hasn't been lower in any of our lifetimes, and that's propelling risk assets, stocks, high-yield corporate bonds, investment-grade corporate bonds, sharply higher from their lows back in March. So in that sense, all these markets are linked. The Federal Reserve has reduced rates to 0. The discount rates are all below 1, except for the 30-year Treasury. So it makes sense that future profits are now installing bigger prices in what we pay for stocks today.